Good evening and welcome to the Financial Channel. Let me walk you through today's market action, which was nothing short of a bloodbath. The Nasdaq closed at 25,709 points, down a staggering 4.18%. The S&P 500 finished at 7,383 points, losing 2.64%. The Dow Jones was the relative outperformer, closing at 50,866 points, down 1.35%. The VIX, our fear gauge, surged nearly 40% to close at 21.51, confirming that we are now in full panic mode. The 10-year Treasury yield rose to 4.54%, while the dollar index DXY broke above the key 100 level, closing at 100.07. The offshore yuan weakened slightly to 6.7888 against the dollar. Bitcoin fell nearly 2% to $60,551. In commodities, WTI crude dropped 2.79%, and spot gold tumbled 2.94%. The strongest assets today were dollar cash and short-dated U.S. Treasuries, as money rushed into safe havens. The weakest sectors were U.S. tech stocks, precious metals, and crude oil. Today's market was a textbook single-session sell-off. The trigger was the U.S. non-farm payrolls report, which came in at 287,000 new jobs, far above the 185,000 consensus estimate. This data point solidified expectations that the Federal Reserve will keep interest rates higher for longer. The resulting rise in real yields crushed all valuation-sensitive assets. The stronger dollar added further pressure on commodities and emerging markets. With the VIX jumping nearly 40%, we are officially in a fear-driven market. And the selling is not over yet. Nasdaq futures are down another 3.78% in after-hours trading, indicating that the sell-off has more room to run. Let me walk you through the global path today. In Asia, China's Shanghai Composite fell 0.74% and briefly broke below the key 4,000-point level. The Shenzhen Index lost 2.21%, and the Chinext board dropped 3.2%. High-valuation growth stocks were hit hard by the spillover from the U.S. tech sell-off, with money rotating into blue-chip defensive names. In Europe, the German DAX and UK FTSE both fell in sympathy, as the non-farm payrolls data was released during European trading hours, weakening the euro and pound and adding to selling pressure. When U.S. markets opened, the three major indices gapped down sharply. The Nasdaq opened below 26,000 points and never looked back, with selling continuing throughout the day with no meaningful bounce. The global inflection point today was 8:30 p.m. Beijing time, when the non-farm payrolls data was released. The leaders of this move were U.S. Treasury yields and the dollar index. Everything else was just following. There are several important expectation gaps we need to discuss. First, the market interpreted the strong jobs data with absolute unanimity: higher rates for longer, bad for risk assets. There was no ignored positive news. Second, we made a key mistake on gold. We expected gold to benefit from risk aversion, but it plunged nearly 3%. We forgot that real yields are the primary driver of gold prices, and the rise in real yields completely overwhelmed any safe haven demand. Third, we underestimated how much the strong jobs data would push up long-term rate expectations, and we underestimated the impact of a stronger dollar on commodities. A critical structural signal emerged today. The 10-year yield broke above the 4.5% resistance level. The VIX broke above 20. And the dollar index broke above 100. The simultaneous occurrence of all three signals marks a transition from a mild tightening trade to a full-blown panic tightening regime. Looking at the intermarket dynamics, a stronger dollar, rising bond yields, and falling stocks form a classic tightening panic combination. For tomorrow's Asian session, this means further pressure on the yuan, potential foreign capital outflows from Chinese stocks, and a fresh test of the 4,000-point level for the Shanghai Index. Our trading conclusion is clear. Holding dollar cash or short-duration treasuries is the optimal strategy. Going long volatility through VIX futures or options is the only clear directional trade. Let me give you some key levels to watch for tomorrow. Chinese stocks are likely to open lower, with the Shanghai Composite potentially breaking below 4,000 points. We expect an opening decline of 0.8 to 1.2%. Japanese and Korean markets will also be under pressure. However, some high-dividend Chinese blue chips, such as banks and utilities, which held up relatively well today, could present a buying opportunity if they are sold off indiscriminately tomorrow. But this window depends on the dollar index falling back below 99.50. If the dollar stays strong, the opportunity does not exist. Tomorrow, we also need to watch China's Caixin Services PMI for May. A reading below 50 would add to selling pressure on Chinese stocks. A reading above 52 could provide a temporary bounce. To summarize, our directional call was correct. We said sell, but our details were wrong, particularly on gold. We need to increase the weight of real yields and the dollar index in our models. For tomorrow, focus on whether the dollar index pulls back from the 100 level and whether the 10-year yield can hold above 4.5%. Ignore short-term news on gold and follow real yields instead. Our probability assessment for tomorrow is 5% up, 15% sideways, and 80% down. Our recommendation is to stay on the sidelines and not to position for an Asian bounce overnight. If you hold short positions, such as Nasdaq futures shorts, you can keep them, but do not add. The strategy confidence level is 0.75. The setup for a tactical long would be if the 10-year yield falls back below 4.48% and the dollar index drops below 99.80. If the dollar stays above 100 or the VIX breaks above 22, do not initiate any long positions. This entire framework becomes invalid if the Fed issues an emergency statement or if economic data is significantly revised before Monday's open.